Hi, this is Daniel here with Value Investing with Daniel. Thanks for tuning in. This is the third lesson in this series that I'm putting together, which is a free value investing course. I hope you like the video. If you do like it and you do enjoy what I'm putting out here, be sure to actually like the video and give it a thumbs up. Be sure to subscribe as well. I'm putting all this content out here for free, and if you subscribe, it'll let other people know that you enjoyed it, and that'll give them a hint that it's good material. So be sure to do that. If you have any questions, always remember you can always ask in the comments below, and if you have any video suggestions, you can always let me know as well. So let's get into the lesson. This is lesson number 3. If you go to my channel, there's a playlist where it's we're going through the lessons. This is lesson 3, which is wonderful businesses and sustainable competitive advantages. What we're looking for in modern value investing fundamentally is we're looking to buy wonderful companies. A wonderful company must absolutely have a sustainable competitive advantage. A wonderful company or a wonderful business essentially makes more and more money every single year. It grows. It grows lots and lots and lots. It makes much more money 10 years from now than it is now. Okay? And it can make that money, and it can make a lot of money and grow very, very fast and eat up market share from its competitors and not be eroded by other forms of competition because it has a sustainable competitive advantage. So really, the heart of a good business is its sustainable competitive advantage. Ultimately, that's what it is. Now, there are some clues that allow us to identify wonderful businesses, to spot them. So when we're screening for businesses and we're looking through them, there are a couple of things, a couple of key points that will really allow us to be able to see, maybe this is a really wonderful business. The first thing, and I didn't write it down, but I should have, is that it has earnings consistency and growth, and free cash flow earnings consistency, or free cash flow consistency and growth, earnings consistency and growth, revenues consistency and growth. This means that if you were to look at the revenues, they're going up, not staying the same, not going down and up like this. It means the revenues are going up. It means the earnings are going up. It means the free cash flow is going up year after year after year. That is the first indicator to you as an investor that this could be a wonderful business. It consistently makes money, and it consistently is growing the amount of money that it's making. I mean, if it's not doing that, nothing else matters. So ultimately, it has to be making money, and it should be making a lot of money, and that money should be growing, not staying the same, not going down, up and down year after year, growing. It's free cash flows, it's revenues, and it's earnings year after year after year. 1 year goes down a little bit, that's okay, but we don't want to see trends like this. We want to see trends like that. Ideally, even like that, exponential. It keeps on going up and up and up, okay? That's your first clue. But just because it has earnings that are growing and revenues that are growing and free cash flows that are growing, it does not mean it's a wonderful business, because there are other factors that we also have to look at, okay? And the other thing is, you want to see that it's doing this for at least like 15 years or 10 years minimum, ideally 15, okay? A wonderful business is not just a wonderful business for like 3 or 4 years of earnings and revenue and free cash flow growth and consistency, okay? It has to be doing this for a good amount of time, like I would say minimum 7 or 8 years. Okay, so a non-cyclical business. All right. So a wonderful business, as you can see there, I didn't write down, but should have revenue, earnings, and free cash flow growth and consistency. It should also have high profit margins. These profit margins are high relative to something else. Generally speaking, it's relative to other companies in their industry, but that can be sometimes misleading. So a wonderful company should have high profit margins relative to its industry, but the problem is some companies don't have equal competitors. So if you take a company like Google, okay, who are we going to compare it to in terms of its profit margins? Like, it pretty much stands out almost on its own, okay? You take any other company that you can think of that sort of has a special place, in terms of its industry, or in terms of the sort of global economy, sometimes it's hard to compare it to other companies within the same industry because what it does is so different. But nevertheless, you can always look at its profit margins relative to its industry and see that it's high, sustainably higher than the other companies in its industry. And that'll also be a little clue. These are all clues that this is a wonderful business, okay? It's not a guarantee. It's just a clue that it's a wonderful business. So if its profit margins are higher than its competitors, sustainably, and its profit margins are increasing year after year on average, then we could say, well, maybe this is a good business. A wonderful business should also have lots of room for growth. Lots of room for growth. We don't want to buy a business when it's dying out in terms of its growth. We want to buy businesses that have a lot of room still to grow. Okay, I'll give you an example. Once there's Okay, let's take Starbucks for example, right? Starbucks, as far as I know right now, controls about 65% of the U.S. Coffee shop market, roughly. As far as I know, I didn't check before this video, so it could be off. If I'm off, let me know in the comments. But I believe that's the case. Maybe 50 to 60%. Okay, how much more can they grow? Like, you see what I'm saying? So once they reach a certain point, they've saturated their markets. There's not much more room for growth within those domestic markets. And whenever a company has to now go to another market, like you start opening Starbucks in Saudi Arabia or something like that, or you start doing things in a different location, you tend to not have that same advantage that you do when you're growing at home domestically. So keep that in mind, right? There's a certain threshold of growth that you can reach where now you've saturated your markets. You want to buy into the company well before that. Okay, you want to buy into the company before it's saturated its room for growth. So if you buy it in the middle, that's okay. If you buy it with still a third to go, that's okay. But you don't want to buy it when now all of its growth has pretty much been used up and it's got no more room to grow. Okay, so you got to look at it. Is there room still for growth? And the way you do that is you look at the market share and you look at what percentage of the market share could theoretically capture, and compare the two and see, okay, is it still got room to grow within this market? Can it destroy more of its competitors and still continue to grow? And for some things, for example, I'll give you an example. I'll go back to Google, for example. Like a third of the planet does not have internet. Okay, once they get the internet, they probably will be searching on Google. So there's room for growth for a company like Google, for example. But when you're talking about companies that have a more specialized niche product for that particular country and domestic market, don't assume that they can go international. Run by great management is another really good clue. The way that we look to see if the management is good is obviously we look to see if they're owners of the company. We look to see if they're buying shares. We look to see if they're able to meet their promises from previous years. So if they said they were going to do something in previous annual reports, do they actually wind up doing it? So and were the tasks that they set forward for themselves successful, generally speaking? Great management will also be able to deliver high returns on invested capital and high returns on capital employed, and these numbers should be growing. So another indicator of a wonderful business, and this is absolutely fundamental, is a company has to have a high return on invested capital and high return on capital employed. These numbers need to be high consistently, twice the weighted average cost of capital at a minimum. Okay, you can have 1 year that it's off, whatever, but it needs to be going up and consistent, just like revenues, just like free cash flow, just like earnings. Okay, having a high return on invested capital, return on capital employed for 2 years is not enough. It needs to be able to do these things consistently. Okay, and finally, not a lot of debt. So for return on invested capital and return on capital employed, it should deliver twice the weighted average cost of capital at a minimum, consistently, year after year after year. Okay, and that is very hard for companies to do. Okay, you're talking probably 1% of companies will be able to do that. Less than one, probably half of a percentage point, okay? And finally, not a lot of debt. We are not looking to buy companies that have a lot of debt. They will go bankrupt. If they go bankrupt, we don't have anything. So the safest way to prevent yourself from buying into a company that's going to go bankrupt, where you'll lose all your money, is don't buy companies with a lot of debt. And wonderful businesses don't require lots of debt, which is what we're looking for. Wonderful businesses. So the financial metric clues of good businesses, which are the financial metrics that we're discussing, high profit margins relative to its industry. But keep in mind, some companies, you can't compare them to anything else because they're so unique. So comparing the profit margins within the industry is generally useful, but keep in mind that sometimes there's no exact competitors for that company. High returns on invested capital and capital employed, like I say, twice the weighted average cost of capital at a minimum, and growing and consistent. Low debt. Like I was explaining in the previous video, I think it was in lesson 1, maybe it was lesson 2, I don't remember. No more than 3 times the sustainable current free cash flows in terms of its net debt. So debt minus cash is your net debt. Okay, your sustainable free cash flow should not be more than 3 times that debt number. Good companies do not require lots of debt. Keep that in mind. Okay. So in order to identify if the company has a sustainable or has a is a wonderful business, we need to answer the following questions. Is its earnings power value above its tangible book value? So companies that are able to grow sustainably will have an earnings power value above its tangible book value. I'm not going to go too much into detail about this. I'm not going to do any calculations really in this video, but just keep that in mind for future videos, that great companies will have earnings power values above their tangible book value. Sustainable competitive advantages is going to be the primary focus of this video, given that all wonderful companies must absolutely have some sort of sustainable competitive advantage. A sustainable competitive advantage is what's going to allow your return on invested capital and return on capital employed to be at least twice the weighted average cost of capital, sustainably and consistently. Like I said, a great company will have its return on invested capital and return on capital employed being at least twice the weighted average cost of capital, and consistently be able to deliver on those numbers year after year after year and grow those numbers in terms of its return on invested capital and capital employed. Okay? Just like its profits, just like its net income, just like its free cash flow, just like its earnings per share, just like its revenues, they're growing. Return on invested capital and capital employed are exactly the same. And the company will be able to continue to make investments and has room for growth in areas where it has a sustainable competitive advantage. So just like we said, it has room within the current or adjacent markets to be able to continue to grow consistently year after year. It hasn't saturated its domestic markets, which are considered its current or adjacent markets, completely. Okay. High returns. This is probably the most important part of the video. So we are looking for companies that have sustainable competitive advantages. Wonderful businesses are businesses that have sustainable competitive advantages. Those sustainable competitive advantages will protect the return on invested capital and capital employed. Ultimately, we are looking to buy businesses with high returns on invested capital and capital employed. But just because the company has high returns on invested capital and capital employed, that means nothing for the future unless there is a moat. The moat is a sustainable competitive advantage. We need to identify clearly, be able to identify qualitatively what the sustainable competitive advantage of the company is. If we cannot point to at least one of the three sustainable competitive advantages, we do not buy the company. Every company that we buy in modern value investing, okay, the way that I practice it, you can do whatever you want. This is just what I do. Needs to have a sustainable competitive advantage. At least one of the three, okay? If they have two of the three, that's even better. If they have three of the three, that's great. But it's not necessarily the amount of moats that a company has, but the strength of one that really matters. So if you only have one competitive advantage of the three, that's okay, so long as it's strong, okay? That's more important than having multiple, really. So contrary to popular belief, so there's this popular belief that there's many different forms of competitive advantages, but ultimately it boils down to three things. The first one is a cost and revenue advantage. The second one is consumer captivity. And the third one is the economy of scale or network effect. Meaning all companies that have some sort of competitive advantage will have one of these three things. They'll have some sort of cost and or revenue advantage. They'll have some sort of consumer captivity, or they will have an economy of scale / network effect. Okay? Let's break them down. In terms of cost and revenue advantages, the most common ways that a company will have some sort of cost and revenue advantage is via a patent, special access, and know-how. Okay, so of the first form of competitive advantage, which is cost and revenue advantages, there's only patents, special access, and know-how. Okay, those three, that's it. So a patent is a patent. Okay, I don't need to explain what a patent is, but if it has a patent, it's a good thing. Okay, generally speaking, patents, like based on my experience, tend to be found in those sort of biopharmaceutical and biotechnological fields that I'm just not familiar with. So, but if a company does have a patent and that patent is not set to expire for a while, that is generally speaking a good thing. So but you got to see if that patent directly turns into profits, and it should if the company's good. But the form of cost and revenue advantage that's the most common in the real world is going to be via a patent. Okay, a patent of some sort. There's also, like we said, for cost and revenue advantages, special access, which is the access to a particular resource. So this often does not actually occur in the real world, but if you, hypothetically speaking, had the only access in the world to a specific resource, you would have a cost and revenue advantage, obviously. Oftentimes, people somehow they think that access to cheap labor or cheap capital is a cost and revenue advantage. It's not, because there are other large companies that also have access to that, generally, almost always. So in the real world, the only form of cost and revenue advantage that generally actually occurs is going to be a patent. There's know-how, which is considered a form of cost and revenue advantage, but know-how can be learned. Okay? Know-how can be learned. Your competitors can pay your employees more and take them away from you, and then you have no competitive advantage anymore. So know-how is nonsense. There is no know-how that cannot be taken away. Okay? Know-how is not a real competitive advantage in the world. It's an academic thing. That's complete nonsense. The only form of cost and revenue advantage, generally speaking, in the real world is going to be through a patent. Okay? So, our first form of competitive advantage is cost and revenue advantages. The only way that that occurs in the real world, almost always, is going to be through patents. The second form of competitive advantage is consumer captivity advantages. These are addiction, social norms, habit, switching costs, and searching costs. Okay, so there's 5. So our first competitive advantage is cost and revenue advantages. There's only one in the real world. It's patents. The second is consumer captivity advantages. It's a second form of competitive advantage. These occur in 5 ways. Addiction, smoking, alcohol. Those are addictions. People will keep on coming back. Coca-Cola, probably, is an addiction. Okay? They keep on coming back because they're addicted to your product. Literally addicted. We can argue that coffee has an addictive quality to it. Okay? So when people are addicted to your product, they will keep on coming back. Addiction. Social norms. Social norms is a big one. When something is normal, if you have a town where everybody drinks Starbucks coffee, and you go to university and you have to be seen carrying a Starbucks coffee cup in your hand to be considered popular, that is a huge competitive advantage. Nobody you're going to feel embarrassed if you're walking around with Martha's coffee shop coffee mug when everybody else is carrying Starbucks. So there's a social norm behind the product. And that social norm sort of reinforces it. So you have addiction, you have social norms, and you have habit. When people keep on buying the same thing over and over, they develop habits, and those habits are very strong. Switching costs means that in order to switch to something else, there's a big risk. Let's use Microsoft as an example. Companies have their entire critical software infrastructure built around their Microsoft operating systems. For them to decide that they're going to switch to some other operating system puts their entire line of business at jeopardy. So when you have switching costs, it means that there's a cost and there's a risk to switching what you're using. Companies that are able to in industries where the switching cost is very high will oftentimes have some sort of competitive advantage for those who use their products or services. And searching costs means that there's a lot of work or effort or money involved in searching for an alternative, and the easiest thing is just to continue to go with the flow with the current product. The final form of competitive advantage is going to be through economy of scale or network effect, which means basically the larger you are, the more advantage you have at making it cheaper, and more people will basically want it. So if you have, for example, we can take the perfect example of a network effect would be something like Facebook or Instagram, where the more people are on it, basically what winds up happening is the more people are on it, the more other people want to be on it, and so forth, and it just goes up and up and up exponentially in terms of number of users, until basically everyone who has internet on the planet has an account, because both of social norms, which we say was a consumer captivity advantage, but also the network effect, which is the more people that are on it will lead to even more people being on it, and so forth. So to review, in terms of competitive advantages, really there are only three. Cost and revenue advantages, which in the real world only occur via patents. The second one is consumer captivity advantages, which occur via addiction, social norms, habit, switching costs, and searching costs. And then the final competitive advantage would be via an economy of scale or network effect, which basically means the larger you are, the more advantage you have at making it cheaper, the more people will want to use your product or services. So that is how to identify competitive advantages. In modern value investing, like I say, we're looking to invest in companies specifically that have some sort of competitive advantage. Because we're only buying wonderful businesses are businesses that are able to make more and more and more money every single year. But in order to do that, they have to have a competitive advantage. And we just learned how to identify those competitive advantages. So that's why this video was so focused on competitive advantages, because if you don't have one, your company is not going to be making a lot of money for a long time. So keep that in mind. Remember, in modern value investing, we're only looking to buy wonderful businesses. Wonderful businesses deliver returns on invested capital and capital employed well above the weighted average cost of capital, at least 2 times above it, sustainably, consistently, and in a method that's growing. And in order for them to be able to do that, they need to have some sort of competitive advantage. There are only 3 types of competitive advantages: cost and revenue advantages, consumer captivity advantages, and economies of scale / network effects. So when you're looking to invest in a company, you got to tell yourself, which of these 3 competitive advantages does it have? If it doesn't, why would you buy it? There are many companies, let's say dozens of companies with some sort of competitive advantage, so only buy those ones. Your universe of stocks becomes a lot smaller once you only start focusing on the ones with some sort of competitive advantage. Those are going to be the ones that make you the most money. And they will also be the ones that have the highest return on invested capital and capital employed, and they're able to do that year after year because of their competitive advantage. So keep that in mind. I hope you enjoyed the video. Be sure to subscribe and like. Thanks. If you have any questions, ask in the comments.